My name is Mark Fleming-Williams, and today I'm joined by John Minnich, our East Asia analyst, to talk about China's housing market. John, there's been some positive signs out of China recently in their housing market. Perhaps it would be best to understand, first of all, how we got here. Could you perhaps give us a little bit of context in the recent history of the China's housing market?
Sure. So the peak period of the housing market that's worth focusing on really begins in the wake of the global financial crisis in 2008-2009. For most of the period up until 2008-2009, low-cost exports were the driving force of the Chinese economy. With the global financial crisis, those export markets evaporated overnight, and suddenly the government was forced to shift focus and begin to rely more heavily on housing construction as kind of the backbone of the Chinese economy. So for the last 6 or so years, that's where we've been. So between 2008 and 2014, we have more or less consistent rises in every major real estate related indicator. But in early 2014, what happened was essentially the market peaked. Mostly for very natural reasons. Part of it was that the government had realized that in 2013 it was overheating, prices were climbing too high. The government did begin pulling back, raising interest rates, certain kinds of mechanisms to begin to slow the market down. But really what happened was that we'd gotten to a point where the oversupply that had been built up through 6 years of very rapid development had led to a general market turn. And so for the last year, we've been sort of in that market turn. Prices have been falling very consistently nationwide, so far very steadily. So we've had a couple of cities where prices have fallen about 10% year on year, but for the most part, they've fallen maybe 3 to 5% year on year. They're falling a fraction of a percent on a month-to-month basis, and it's been fairly generalized. What's happened in the last couple of weeks is we've seen very scattered signs in certain parts of the country that markets are beginning to recover. And these are very, very tentative at this point, but it's the first inklings that perhaps at least the first wave of the slowdown has reached something of a fulcrum.
Okay, so we had 6 great years, followed by 1 slightly dodgy year, and what we've had recently is it's begun to look positive signs of some kind of recovery. Do we have any theories? Anything to put this down to? In
terms of the driving forces behind it, I would say, we have a couple of proximate drivers in recent months. So one is that the government has, consistently for the past 6 to 7 months, the government has been relaxing a variety of restrictions that formerly were in place to slow down an overheating market. So a lot of those come down to, well, one is lowering interest rates. That's been kind of a background noise that certainly had an effect on the housing market. We also see the government relaxing mortgage policies. So basically making it easier for people, especially buying a second or a third home, to get a mortgage, requiring smaller minimum down payments, things like that. Now, all of these things we do think have come together in the last couple of months to give a bit of a tailwind to markets in certain parts of the country. But I would emphasize again that up to now what we've seen is, for instance, prices only increasing in one major Chinese city and prices stabilizing in a handful. But on a year-on-year basis, the market, broadly speaking, is very much still slowing. It's just that very first tentative signs of scattered recovery in parts of the economy.
So we've got small, mild signs of improvement and various government policies which are driving it, it looks like. It sounds to me like you're not necessarily a believer in this recovery, that you're not seeing it as being perhaps a return to the glory days of pre-2014. Would that be fair?
Very much so, yeah. I think it's highly unlikely that we would see anything even approaching a return to the kind of massive growth, massive rises in home prices, massive growth in real estate-related investment that we saw over the course of the last 6 years. First and foremost, like I said, we're coming off of a period of such intense construction, and the oversupply at this point is so significant that to see yet another period of comparable growth in investment and construction, it would defy not only all economic logic, but also the Communist Party's policy priorities. We're at a point now where the idea now going forward is for the government to begin or to continue the process of urbanizing the interior and to begin to create the conditions so that we have new classes of incoming urban residents who can begin to metabolize that existing housing oversupply rather than developing even more oversupply on top of it. And I would just set this against the backdrop of, China's economy right now is in the process of transition from an old economic model, the economic model I described before, which was export-driven and then construction-driven, towards a new economic model, one in which the economy is far more heavily urbanized, in which within those urban centers, within those urban economies, economic growth is driven by domestic consumption, by high-end services, and by value-added manufacturing. And the idea is that ultimately this is going to begin on the coast, but spread to the interior as well. Now, to create that kind of economy, you don't want to have the same kind of government-led investment into housing construction that you had the past 6 years. You want to start using or developing, implementing a whole new set of policies that encourage local government financial autonomy, that encourage or that expand credit access to small businesses as opposed to property developers, things like that. So I would say going forward, we don't expect to see a return to the quote-unquote boom years or the glory years of the early post-financial crisis days.
Okay. Well, thank you very much, John.
Thank you.
For more on this and other topics, please visit stratfor.com.